Good morning and welcome to the Killik and Co market update. Clearly all eyes are on Ukraine this week. Markets have been weak over the course of February as investors feared a Russian invasion of Ukraine. But strangely, when the full-scale invasion actually started yesterday, many markets actually finished up. Yes, the FTSE 100 index was down yesterday, but US markets finished in positive territory, as did the MSCI World Index. Here's a chart showing the MSCI World Index just over the course of 2022 in percentage terms. And you can see the index has lost almost 10% over the course of this year so far, but it did have a little tiny bounce yesterday. And that could be because markets had priced in the threat of invasion before it actually happened. It could be because it's unlikely now that central banks will raise interest rates as quickly as previously thought, and that could potentially be good news for some global markets. The same could not be said, however, for Russian markets. Here's a chart showing the Russian RTS index, which is down over 50% for this year so far, probably due to the fact that the West has imposed economic sanctions on Russia, which are likely to harm its economic growth. We've also seen some severe weakness in the shares of Russian companies that trade outside of Russia. For example, here's a chart for Evraz, which is a mining company that actually trades in London, and it is part of the FTSE 100 index. This is also down 50% over this year so far, and it's probable that some investors are worried that the company might be kicked off the London Stock Exchange and they're potentially selling out before that actually happens. Western governments have been deliberating exactly what sanctions to impose on Russia. Clearly some action is needed given Russia's blatant disregard of international law, but the problem is that sanctions imposed on Russia could potentially end up harming the West as well. Russia is a major producer of a number of vital commodities. For example, Russia is the world's third largest producer of oil and the second largest producer of natural gas. So any sanctions imposed on Russia that would prevent it from exporting those commodities could potentially push those prices up and cause pain for Europe and the rest of the world as well. Here's a chart showing European natural gas prices over the last 2 years, and you can see that big spike this week in expectation of more sanctions on Russia. The same is true for oil. Here's a 10-year chart for Brent crude, and this week the price went above $100 per barrel. These higher energy prices will encourage Europe to move to a position of energy independency. And yesterday, when this full-scale invasion started, we saw some big share price rises in European renewables. 2 Danish wind power companies, Ørsted and Vestas, were up 15.8% and 11.5% respectively yesterday. The situation with Russia and Ukraine is clearly a big concern right now, but we found it quite reassuring to look back at the market reaction to previous geopolitical events. Here's the MSCI World's reaction to 9/11, which took place in a long period of market weakness following the dot-com crash. When 9/11 happened, the market did drop, but it recovered to its former level within a matter of weeks. We've then got the invasion of Iraq in 2002, and again the recovery was relatively quick. And finally, there was Russia's annexation of Crimea in 2014, following which the market reaction was minimal. We'll continue to monitor the situation very closely over the coming days and weeks. Looking ahead to next week, we are expecting results out from Salesforce and Costco. That's it from us. Enjoy the weekend, and we'll see you next Friday.